Breakout patterns are when the market goes from a low period of volatility to a much higher period of volatility. We see that a lot on uptrends and downtrends. What we see is impulsive moves. So the market makes a large move to the upside, and then we see a small period of consolidation before the next large move to the upside. We call these flag patterns. We're going to talk about those in just a second. We also see this in the form of what I trade and call, and what is called, I guess you could say, ascending and descending wedges. What this means, an ascending wedge, is when price has a level of resistance that it cannot get above, but as it's testing that level of resistance, the support level is rising. So that means that buyers are coming in sooner and sooner at higher and higher prices till eventually that pattern breaks out to the upside. And a descending wedge is the opposite. We have a level of support. We have lower highs coming in, showing that sellers are stepping in sooner and sooner at lower and lower prices. And eventually that breakout level gives way to what we call an ascending and descending wedge breakout pattern. Those are the two breakout patterns I personally use the most. There are many more breakout patterns that you are free, like everything else in this video, to go study on your own. But I want to talk about the ones I'm actually familiar with and the ones that I personally use. So let's take a look first off at flag patterns. So let's talk first, how do we use flag patterns? We now know what flag patterns are. Take a look first off at flag patterns. So let's talk first, how do we use flag patterns? We now know what flag patterns are. How do you use them? Well, I use them to capitalize on volatile trends. What did we talk about earlier? A volatile trend oftentimes stays above the 20-period moving average. As you can see on the chart here, we have price staying above the 20-period moving average. So the way I like to use a flag pattern is if we are staying above the 20-period moving average and we've just had an impulsive move to the upside, then I want to draw out a flag pattern on my period of consolidation. After that period of consolidation, we get what is known as a breakout candle. This breakout candle breaks the top trend line of that period of consolidation, and this is when most traders decide to enter on a flag pattern trade. I'm going to give you some specific rules in just a second, but let's take a look at one more example. We have another situation here where the market's continuing in trend. We make an impulsive move that breaks above previous resistance. We then see this market have a period of consolidation, this pullback that, as you can see, looks like a flag, right? We have the pull, which is normally the amount of price, the impulsive leg before the period of consolidation. We have a small period of consolidation, then we have our breakout candle, and the market continues in that uptrend. This happens time and time again in volatile trends, and that's how we can take advantage of flag patterns in volatile trends. Now, just as with everything in our trading, we need to have some objective rules here. So for me, one of the best objective rules I have found when trading flag patterns is that I want to only trade these patterns when they happen above or near the 20-period moving average. That's the only time I can actually place trades based on flag patterns, because the 20-period moving average acts as my filter for highly volatile trends. And I only want to take flag pattern breakout trades if the trend is highly volatile, because that's my best chances of having a move higher. And for stops and targets, we'll go ahead and discuss those. You should have a pretty good idea. Where do you think I would put stops and targets? If my entry candle is this breakout candle right here, what do you think I would do for stops? I would have my stop loss below the previous low by what? 1 ATR, as we discussed earlier. So let's go ahead and set this trade up. It would look something like this, and a target up here at the previous level of resistance right here. So at this point, you know exactly how I trade bullish flags. This video has gotten well over an hour long, so I'm not going to do an example of a bearish version of this. Just flip it upside down. It's literally the same exact thing in the opposite direction. In terms of a bearish flag pattern, we'd be waiting on the market to head down with an impulsive move, head down with an impulsive move. We would be trading this small period of consolidation on a breakout of that period of consolidation to the downside. We'd be selling or going short. So that is, again, how I trade flag patterns. Let's take a look now at another breakout pattern that I really enjoy using, which is the ascending and descending wedge. Here's an ascending wedge, and unlike flag patterns that take just a few candles to set up. These types of patterns normally take anywhere between 20 and 50, maybe even 100 candles to actually set up. They're larger patterns. But essentially what we're looking for with a wedge pattern is a level of resistance that the market is having trouble getting past. But at the same time we're having trouble getting past this level of resistance, we want to see sellers stepping in at higher prices. What this is showing us is that, excuse me, I said sellers, I meant buyers. We want to see buyers stepping in at higher prices. What this is showing us is that buyers are more and more interested in this currency pair, stock, crypto, whatever it may be. They're more interested in higher prices. And as we continue to make these higher lows, the not inevitable but likely scenario is that eventually we bust through this level of resistance because sellers eventually give up trying to push the market down from this level of resistance. As their pushes down get smaller and smaller and we get higher and higher lows, they eventually give up. And when they do, it looks something like this. We get a breakout of that level. Now, one of my favorite ways to trade this is on the pullback, almost like the double top and double bottom we were looking at earlier, but a lot of traders trade on the breakout candle that we can see right here. The way I like to trade them is after this breakout, I like to wait for a pullback back into my zone of resistance. When I get that pullback, I look for buying pressure. What do I define as buying pressure? A green candle. So once I pull back to that zone and get a green candle, that is when I personally will enter the trade. So now we have a pullback into the zone, waiting for a green candle, boom. Personally, I would be entering into the trade here. We'll go ahead and do the trade setup. We've had all of our rules met for an ascending wedge. We have a level of resistance that has acted as resistance multiple times. We have rising support levels coming into that level of resistance. We now have a breakout of that level and a pullback to that level of resistance. At this point, yet again, whenever I find buying pressure here, that is when I want to place a trade. Because of the fact that I waited for the pullback, I can now have a much smaller stop loss based on this previous swing low. So I have an ATR of 36 pips on my entry candle. I want to be 36 pips below my swing low. So 39, let's go 40 plus 36 is 76 pips. 76 pips would be about right here. With that being the case, where's my target going to go? Well, if I place targets based on structure, the next level that looks to be a major level of structure support or resistance is right there. So let's see what that would look like. Do I get more than a 1-to-1 reward to risk? I get about a 1-to-1 reward to risk ratio. Maybe move stops at break even when the market hits that price, right? And then continue with the position. Let's see what happens. We push up, we push back down, stopped out for break even, or we watch the market continue and eventually push higher. But that, regardless of how that trade worked out, is how I would be trading ascending wedges. And the exact opposite is true. Again, this video is getting very long, so just flip that over. A bearish version, a descending triangle, is nothing more than a level of support that's hit multiple times while we have falling resistance levels or falling swing highs. Falling swing highs plus the same level of support is going to give us a descending triangle. Descending triangles, once broken to the downside, are likely to continue in that direction. Personally, I wait on this pullback to come back into that level. Sometimes it doesn't happen and I miss out on some trades, but it gives me a better reward to risk setup. So I like to wait on that pullback in terms of getting. Doesn't happen and I miss out on some trades, but it gives me a better reward to risk setup. So I like to wait on that pullback in terms of getting a better reward to risk on these trades.